The year is 1913. Woodrow Wilson sits in the Oval Office. He is grappling with a decision that will shape the future of the United States, whether to sign the Federal Reserve Act. This act proposes the creation of a central bank, an institution designed to oversee the nation's money supply and maintain financial stability. In our timeline, Wilson signs the act, giving birth to the Federal Reserve. But what if he hadn't? What if the United States had charted a course through the 20th century and beyond without a central bank? This essay explores this alternate history, delving into a world where the Federal Reserve never existed. Without the Federal Reserve, the U.S. economy would have been a ship sailing without a rudder, tossed about by the unpredictable waves of economic cycles. The Federal Reserve, since its inception, has acted as a stabilizing force, a lender of last resort in times of crisis, and a manager of inflation. It has been the bedrock upon which the U.S. financial system has been built. Without it, the U.S. would have faced a much rockier road, fraught with financial panics, unchecked inflation, and prolonged economic downturns. The absence of the Federal Reserve would have been felt far beyond the borders of the United States. The dollar's position as the world's reserve currency, a status achieved in the aftermath of World War II, would have been uncertain at best. The stability provided by the Federal Reserve has been a key factor in global confidence in the dollar. Without it, the international monetary system would have looked very different, likely more fragmented and prone to volatility. Imagine a world where financial crises are more frequent and more severe. Imagine a world where the US struggles to finance its involvement in global conflicts. Imagine a world where the technological and financial innovations that have come to define the modern era are stifled by a lack of access to capital and a pervasive sense of economic uncertainty. This is the world we will explore, a world where the Federal Reserve never came to be. To understand the potential ramifications of a world without the Federal Reserve, it's crucial to first examine the period that preceded its creation. The late 19th and early 20th centuries were a time of rapid industrialization and economic growth in the United States, but this progress was often overshadowed by financial instability. The absence of a central bank meant there was no lender of last resort, no entity to provide emergency liquidity to banks during times of panic. The National Banking Acts of the 1860s, while intended to create a more uniform and stable banking system, had unintended consequences. Banks were allowed to issue their own banknotes, but this led to a confusing patchwork of currencies and hampered interstate commerce. Moreover, the requirement for banks to hold reserves against their notes was often inadequate and inflexible, leaving the system vulnerable to shocks. This era was plagued by regular financial panics. These panics often began with a run on a single bank or a small group of banks, triggered by rumors of insolvency or reckless lending practices. Without a central bank to step in and provide liquidity, these runs would quickly spread throughout the system, leading to widespread bank failures, a contraction of credit, and economic downturns. The Panic of 1907 stands as a stark example of the pre-Federal Reserve era's financial fragility. What began as a speculative run on a few New York trust companies quickly spiraled into a full-blown financial crisis. Trust companies, unlike traditional banks, were not subject to the same reserve requirements and had invested heavily in risky ventures. When their investments soured, panic ensued. Without a central bank to act as a lender of last resort, the situation deteriorated rapidly. Banks across the country, fearing a run on their own deposits, began hoarding cash, effectively shutting down the flow of credit that was essential for businesses to operate. The stock market plunged, businesses failed, and unemployment soared. Order was only restored through the intervention of J.P. Morgan, the legendary financier who used his personal wealth and influence to rally other bankers and provide emergency loans to struggling institutions. Morgan's actions, while successful in averting a complete collapse, highlighted the inherent instability of a financial system without a central bank. The outbreak of World War I in 1914 presented a new set of challenges for a nation without a central bank. The war effort required massive government spending to mobilize troops, purchase equipment, and support allies. In our timeline, the Federal Reserve played a crucial role in financing the war, facilitating the sale of war bonds and managing the money supply to prevent runaway inflation. Without the Federal Reserve, the US government would have faced a much more difficult task in financing its war effort. The fragmented and decentralized banking system would have struggled to absorb the massive influx of government bonds. Interest rates would have likely skyrocketed, making it even more expensive for the government to borrow money. This financial instability would have had real consequences for the war effort. The US might have been forced to scale back its military commitments or face the prospect of hyperinflation, eroding public confidence and potentially undermining the war effort. The war, already a costly and bloody affair, would have likely exacted an even heavier toll on the US economy. Section 5, the Roaring Twenties and the devastating crash or depression made deeper. The 1920s, often remembered as a decade of prosperity and excess, were also a time of growing economic imbalances. Speculation in the stock market was rampant, fueled by easy credit and a lack of regulation. This speculative bubble was a disaster waiting to happen, and when the stock market crashed in October 1929, the consequences were catastrophic. In the absence of the Federal Reserve, the crash would have been even more devastating. Without a lender of last resort, banks were ill-equipped to handle the wave of withdrawals that followed the crash. As panic spread, banks failed by the thousands, wiping out the savings of millions of Americans and bringing the nation's financial system to its knees. The Great Depression that followed was the worst economic downturn in modern history. Unemployment soared to unprecedented levels, businesses collapsed, and breadlines became a common sight in cities across the country. Without the Federal Reserve to provide liquidity, stabilize the banking system, and stimulate the economy, the Depression would have likely been even more prolonged and severe. In a world without financial stability, every victory comes at a high price. The absence of a central financial authority means that economic fluctuations are more severe and recovery from downturns is painstakingly slow. Without the Federal Reserve, the economy is like a ship without a rudder, tossed by the waves of market forces. Imagine, if you will, a mirage in the desert. That's what an economy without a central bank feels like. It may appear stable for a moment, but it's an illusion. Without the Federal Reserve to guide monetary policy, inflation and deflation run rampant, making long-term financial planning almost impossible. Businesses and individuals alike struggle to make sound economic decisions in such an unpredictable environment. The lack of a central bank creates a perfect storm, a recipe for disaster. Without the Federal Reserve's oversight, financial institutions take greater risks, leading to more frequent and severe banking crises. The safety nets we take for granted today, such as deposit insurance, are non-existent, leaving people's savings vulnerable. The economic landscape becomes a minefield where one wrong step can lead to catastrophe. Over the long term, the absence of the Federal Reserve leaves deep scars on the economy. The lack of a stabilizing force means that economic booms and busts are more extreme and prolonged. Social inequality widens as the wealthy find ways to protect their assets, while the less fortunate bear the brunt of economic instability. The dream of a stable, prosperous society remains just that, a dream, unfulfilled and out of reach.